this week sees the ECB step forward in a rate decision that by and large isn't expected to bring any movement in terms of rates itself. Instead, with markets relying on it to give them guidance on where we go from here, considering the raft of rate cuts we've seen over the course of the past year and a bit. So let's get into what to follow for this ECB meeting and what exactly we think could move the markets. So key to it here is the fact that we've already seen a whole host of rate cuts from the ECB. They started off with rates below the rest. They raised rates, but remained below the rest. And now they've cut rates at a rapid clip and are, apart from the SMB, below the pack when it comes to the sort of major central banks that we've got listed here. And so the question mark here is, where do we end this process? And certainly with the fact that we've got, as we can see from this image, the likes of the Bank of England, the Federal Reserve at the top of the pile, likes of the RBA also joining them. You've got some central banks that have a huge amount of easing left to do. You've got some central banks that have really done a lot and started pretty low, and the ECB is in that position, right? So when the ECB stops easing and the rest of the pack continue easing, then you see a potential shifting in terms of the narrative. And so that's why we need to know exactly where this easing process ends. But certainly if you look at the rest of them, it's been a sort of stop-start period of easing for many, not necessarily so much for the ECB. It's been very consistent in terms of the easing, and that really highlights the economic weakness that's evident within the region, but also the declines we've seen in terms of inflation. In terms of market expectations, these are the expectations according to the Refinitiv Icon platform. As we can see here, market's pricing a 91% chance that we keep rates steady at 2%. And there on out, you're going to be looking at basically the potential for a rate cut in September, more likely October, December kind of time, but essentially one more rate cut for the remainder of 2025. That's where the PMI data over the course of this week, alongside the sort of tone, the linguistics, the language for this meeting, that's where it comes in, because shifts in terms of market expectations will be the kind of things that could really provide some price action movement, some volatility around this meeting. So where's that volatility going to happen? More likely it's sort of September, October kind of time for those meetings. That's where we could see some sort of shift in terms of tone. Are we going to see a move towards 2 rate cuts this year? Seems unlikely. Are we going to see a shift in terms of rate cuts sort of brought forward into sort of September, which at the moment is not the base case? Well, that's a potential shift that could happen. So certainly keep an eye out for that. If we look back at the minutes that we saw previously, one of the key concerns that people had been sort of speculating around is the potential for an undershooting, which essentially means they tried to hit that 2% target on inflation, but it essentially goes below inflation, and we see it remain below there for some time. That would point towards a possibility that they need to ease further. They need lower interest rates to really reignite inflation, but also reignite economic strength within the region with economic activity. So those minutes point towards a feeling that we need to continue to do more. And certainly when you look at the ECB projections, they do highlight a feeling that within 2025 and 2026, we're going to see inflation running below 2%, potentially picking back up later into sort of late 2027. And so that might be something that they want to remedy. I mean, look, you've got 2 schools of thought. Number one, you've got the idea that potentially inflation having already been above 2% for some time, maybe we could do with sort of taking the heat off somewhat and run it a little bit below target for a while. Or else if they're just strictly sticking to that 2% target, then you have the potential for, once again, the need to enact additional rate cuts to really sort of reignite the economy and the inflation outlook for the ECB. In terms of inflation expectations, according to the ECB's latest survey, we can see here that despite a pickup last time around, and this was the March survey, you can see in terms of the June survey, we saw a downside move in terms of inflation expectations across a number of different metrics. So employees, sort of input costs, selling prices, wage costs, all of them saw downside moves for inflation expectations for both small and medium-sized businesses and large businesses. So notably, it feels like the expectation of those operating within the ECB do expect to see further downside coming into play for inflation over the longer term, over the coming year. So this sort of feeds into the narrative that by and large inflation is under control, and therefore there may be a need to enact further rate cuts. Now, part of why this week is so important is the ECB, so they give us a guide on exactly where they see things playing out, but also the PMI numbers, because we have a raft of PMIs coming out. And as we can see here, we've seen the sort of manufacturing figure climbing back towards that 50 mark. Bit of a pop recently in terms of services inflation, but the composite reading does still remain in expansion territory. Here's the sort of outlook in terms of those PMIs, and we can see here really the sort of manufacturing in Germany expected to improve. So that's a positive. The composite expected to improve in Germany. The composite in the Eurozone as a whole expected to improve. So by and large, if we do see these kind of sort of stronger figures, it does signal the potential for the ECB to take a relatively not cautious but patient approach, and not necessarily move the dial in terms of talk of potentially needing to cut rates in September, at which point, potentially we could see the likes of the euro picking up a little bit in response to that. But certainly I think the fact that we see the PMI numbers released prior to the ECB meeting should make for an interesting session. It's also notable that we have seen a deterioration in terms of expectations for earnings over the course of much of this year, ever since we saw the reciprocal tariff announcement from Donald Trump. And so this really feeds into the same thing. This is talking about the profitability and the health of businesses within the ECB or within the Eurozone. And there's a feeling that that will deteriorate over time and that it could be a difficult year. Of course, we're running through a period at the moment where we've got the European Union and the US potentially battling it off, or likely battling it off in terms of trying to find some sort of an agreement on the trade front. Lutnick has said that he feels confident there will be an agreement. The European Union are busy sort of tallying up a raft of countermeasures if they don't find agreement and if tariffs do come into play. Whether that will be the case remains to be seen. But certainly that's going to really add to sentiment in the region. And there's a perception that if we think we're going to see tariffs hiked up, then does the Eurozone and the EU enact countermeasures? And is that inflationary by nature? Does that tie the hands of the ECB? Or is it the opposite, that the ECB decide that the economy is going to be in a difficult position with higher tariffs from the US, which is a key market, and they feel the need to step in? So keep an eye out for commentary around that topic as well. Now, in terms of the charts, let's just look at the charts here. First and foremost, I wanted to bring up the chart for Euro Yen. I think this is a really interesting chart, coming off the back of actually a key weekend for the Japanese yen. We've been seeing it under pressure of late because of the election, and ultimately the election concerns were proven to be correct, because we saw the LDP party lose their majority at the upper house. But nonetheless, it's been a bit of a sort of buy the rumor, sell the fact move here, because we've seen the yen actually gaining a little bit of ground despite that fact. But the reason I wanted to bring this up really is that long term, the trend is very bullish here. And I just thought, this is such an incredible trend that's playing out here. I think it's a really interesting market to be following. Now, bear in mind, right, if we're looking at potential strength for the euro, this talks of the potential for them to hold off for longer, a patient approach from the ECB. And I think we're approaching the sort of the last innings for easing under the ECB. And therefore, I think we do have the case for a stronger euro. Of course, there's risks when it comes to tariffs. So that's worth bearing in mind. But certainly the gains that we've been seeing of late do provide a very nice trend. Now, can see here, if I sort of try and tally up as many of these lows as possible, we have broken out through trendline support. That is a bit of a sort of warning sign. However, you could be moving into a sort of slowing down of that uptrend. And so we'd really need to break the 170.8 to negate that trend that has been playing out at the moment. But really sort of moving into a consolidation phase at the moment. Perhaps it's the case that the ECB meeting provides that emphasis, that basis for further upside from here. Depends exactly how it plays out, but certainly unless we break the 170.8 mark, then I think this looks an interesting market for a trend continuation move. Now, in terms of the DAX, what we've been seeing over the long term is bullishness, and more recently, significant strength. Now, we had been seeing, of course, this move where we see outperformance for, let's say US 500. We had been seeing outperformance for German stocks against their US counterparts. That has faded recently. So that flow of funds out of the US into places like Europe really faltering a little bit more recently. So that story is kind of going away a little bit. Does that mean that we shouldn't be long the DAX? Well, not necessarily so, but certainly at the moment, markets aren't necessarily just desperate to try and get into any asset other than the US. Instead, people are feeling a little bit more confident about the US, hence the record highs that we're seeing over there. But let's just sort of grab a few of these Fibonacci levels and see exactly how this is sort of translating into sort of pullbacks. It's a nice 76.4. Oh, so let's just see exactly what this latest move has been. So this is probably the more important one considering where we are at the moment. So we've come into that deep fib zone. We've rallied up through this double bottom formation. We've now pulled back. In my mind, I think that what we're seeing at the moment here is a pullback before we see the bulls back into place. So essentially, let's just try and get that out of the way. Essentially, sort of A, B, C into a deep retracement, rally out of this rally, then we come into this zone here. I don't know that this sell-off is over, right? So that's why I'm not necessarily just going to say exactly where it is here, but come into this zone and then potentially move upwards from here. Now, if we see this is a retracement, then where are we in that sort of realm? Well, we haven't hit the 61.8 quite yet. That points towards the potential for further downside over the near term. That support level is at 24143. Below that, we've got the 76.4, which is 240.59. Essentially, this is a call on the idea that we've bottomed out here with the ABC style sort of Elliott wave retracement, which is how I like to see it, coming into the deep fib zone, which is how I like to see it, set within a long-term uptrend. Again, exactly what I'm looking for. And therefore, the next rally, the pullback, in my mind, is a retracement before the bulls come back into play. We don't necessarily know exactly how deep that retracement is going to be, but I wouldn't be surprised to see another move lower over the near term, and in which case, this zone looks really interesting between the 76.4 and the 61.8 fib. And then we'd be looking at a 23924 level that, as long as we don't break that level, then, the bulls still, in my mind, are likely to come back into play. So that's how I see it. I see this current pullback as a retracement before the bulls return to play once again, set within a clear bull trend here for the DAX. An interesting one to be watching out for. Like I said, look out for the PMI numbers, look out for the ECB. I don't necessarily think it's the case that it's like bad news equals good news because of the fact that it makes the ECB cut rates, right? If we see strong PMI numbers, this is good news, right? And ultimately, why are they cutting rates? Why does the market get excited when we see rates cut? Well, it increases liquidity, but it's good for businesses, right? It's good for the outlook of the underlying economy. So, it doesn't necessarily mean that we have to constantly see bad data for us to celebrate. If we see good data and we've already got relatively low rates, I think that's a good environment. That means that the low rates are kicking in and providing the basis for outperformance for equities going forward. Of course, we're going to see volatility and question marks raised around the tariffs. That is in no doubt. So keep an eye out for headlines on that front as we approach the 1st of August. But for me, equity market's still looking constructive. pullbacks over the near term for the DAX look to be short term in nature. And that euro yen pair, I think that's a really interesting uptrend that until I see otherwise, the trend is your friend. I hope that's been useful. Make sure to like, subscribe, and follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot.